My name is Onkem Kiva. I head up the Rand Merchant Bank Technology, Media and Telecoms business. Rand Merchant Bank is an African regional bank that focuses on investment in Sub-Saharan Africa, and we support clients across various sectors, with my specific specialization being technology and telecoms. Thank you everyone for joining this session. It is after lunch, so typically quite a bit is needed to get everyone to get going. I think there's been a number of ideation and sharing on technology services and a number of capabilities that are critical to take the continent to the next level. But often infrastructure and the challenges and the infrastructure gaps that the continent faces makes all of those initiatives quite difficult to realize the potential that we can get to. And the next panel really focuses on the infrastructure investments required to put the guardrails in enabling services and technology. And to moderate this session is the head of private markets for Mergence Investment Managers, Kasief Isaacs. Kasief Isaacs heads up the private market team, and his responsibility is for the fund strategies across the region. This includes energy infrastructure, as well as focusing on impact-related projects across South Africa and the SADC region. Kasief, if you can come up and introduce the panel. Thank you.
Good afternoon, everybody. Thank you for joining our session. I will ask our panelists to introduce themselves shortly. I think one of them has a silver bullet, about $100 billion to close the infra funding gap in Africa. You can take it out when you're ready. But yeah, on a more serious note, I head up the private markets team at Mergence. We currently manage about just over $200 million in the region, focusing predominantly on South Africa, Namibia and Lesotho, and about 90% of that capital is invested in infrastructure. So infrastructure is very close to our hearts. And as we all know, I started with that $100 billion funding gap, but that is the reality today. Africa faces a constraint of between $70 and $110 billion annually of infrastructure funding shortfalls. But today we're going to take a slightly different tact in that we're going to focus on a few areas. So how have businesses been forced to adapt to deal with the lack of infrastructure on the continent? I've got a couple of credit specialists with me that will talk about how credit products can support infrastructure rollout across the continent, and then we'll look at regulations. So are regulators keeping pace with the need to accelerate infrastructure rollout on the continent? And then last sub-theme will be around localization, and are we maximizing the opportunity to ensure that there's enough local content and local ownership and participation in infrastructure projects. With those remarks, let me quickly ask my panel, starting on my far left, with Kola just to introduce himself, and then a minute to a minute and a half, and we'll just quickly go around. Thanks, Kola.
Hi, everyone. My name is Kolawole. I'm the Chief Investment Officer at the Nigerian Sovereign Investment Authority. Okay.
Your mic's working.
My mic's working, right? Can everyone hear me? No? Okay.
You can keep going.
The Nigerian Sovereign Investment Authority is the sovereign wealth fund of Nigeria. We have about $4.5 billion under management. We invest in 3 core pillars, which are infrastructure in Nigeria, commercially viable infrastructure in Nigeria. We also have an endowment-like fund that invests globally with an endowment-like strategy for the future generations of Nigerians. And lastly, we have a fund called the Nigerian Stabilization Fund that is supposed to stabilize the government during times of economic stress. That's a quick summary.
Thanks, Kola. Hi, I'm Rachel. I work with Village Capital. We're predominantly an accelerator. We support high growth potential tech ventures that are SDG aligned. We also make some direct investments. We've got 12 in Africa, and our alumni have gone on to raise 200 million in follow-on capital in Africa. And so I'll be predominantly speaking from that perspective, early stage tech and innovation, high growth potential ventures. Looking forward to the conversation.
Hi everyone, my name is Martijn Proos. I work for 91. 91 is a global asset manager and started in 1991 in South Africa. We still have a lot of our assets managed in Africa. I sit within the private credit department, focusing on emerging markets. And my particular responsibility is to manage a fund called the Emerging Africa Infrastructure Fund, which is a $1.2 billion debt fund that provides long-term debt facilities to privately owned and managed infrastructure projects on the continent. Has been around for 20 years and is invested in about 19 countries at the moment, 9 infrastructure sectors across 60 borrowers.
Good afternoon, my name is Youngsik, working at Citibank. So I'm responsible for export credit agency, multilateral agency, and TFI supported financing across Sub-Saharan Africa for the infrastructure or working capital financing for our clients in sovereigns, corporate and financial institutions. Citi, as one of the most international banks globally, we have local presence in 15 countries in Africa and very, very active across the region. So thank you.
Hi everyone, my name is Chinedu Azodoh. I'm co-founder and president of a company called Max. We're one of the largest 2- and 3-wheel players on the continent. We enable commercial taxi drivers access vehicles on a rent-to-own basis, including a bunch of other services like insurance, emergency response, healthcare, pension, group life, and everything else in there to enable them work. The drivers work with us, pay a subscription, and the path to own. The percentage of our fleet today is electric, and we also manufacture our electric vehicles today through partnerships with ODMs out in China and a few other countries in the world. We were operational for the last 8 years, operating in 3 countries in Nigeria, Cameroon and Ghana. We have about 25,000 barrels of water on our platform, and we expect to be profitable within the next quarter, or at least 2 quarters. Okay, thank you.
Thanks. Thanks. Let me start with Rachel. So Rachel, I think just an example in your experience of how business models have had to adapt to the lack of infrastructure on the continent.
Thank you for the question. Yeah, it's not always a direct link in people's minds between high growth potential tech ventures and infrastructure, but it is an essential link because the infrastructure that is available will affect what gaps ventures can fill, but also what type of financing they need and how they build out their business models. So to illustrate, there's one example from our portfolio of alumni. They joined our program as a SaaS solution for farmers, hoping to kind of tap into existing logistics chains and transport links and warehousing, but unfortunately it just wasn't available. So they have successfully raised a Series A now, but it took them a long time to get there, and they ended up having to raise equity financing to pay for things like trucks and warehouses, which really affected the economics of the model and diluted the founders, and it just makes it a lot more difficult for the venture capital model to work in its purest form. Thankfully, we are seeing more and more affordable debt that is kind of helping with this, but it's just to reiterate that if we want to see transformational tech innovation, especially with education and healthcare, agriculture, that infrastructure development really does kind of enable directly tech innovation and high growth potential businesses to access growth capital and grow their businesses.
Thanks, Rachel. Chinedu, I think for you are clearly heavily reliant on functioning road and logistics infrastructure. So how has your business had to react or been impacted by deficiencies or gaps in infrastructure on the continent?
I mean, that's a great question. So today we have primarily motorcycles and tricycles working, but at some point we actually ran cars and tested them out, right? And then realized very, very quickly how unprofitable it is to operate cars in the markets that we're at, primarily because the roads are not what they need to be. So you spend too much maintaining, and it just destroys value, right? So if cars don't work, you want to figure out, okay, what else can we do at any kind of scale that a private individual, not the government, can actually do, right? And so we tested out motorcycles and tricycles and have kind of stuck with motorcycles and tricycles, right? When we built out when we started the electric program in 2019, one of the things we found that we had to do was we actually had to go to China and employ an ODM to work with, where today we own the design for the electric vehicles that we operate, because we actually had to help them design something that made sense for the continent, because the kind of test roads they had and whatnot were fantastic for a mythical world that doesn't exist, right? But for the reality that we were dealing with on the ground, we realized that the kind of vehicles that we were getting out of both China and India just didn't come close to what was needed, right? So today, for example, I'm a pretty big man. I weigh 170 kilos, right? I'm comfortably able to ride one of our electric motorcycles with a passenger, and I'm doing 110, 120 kilometers in terms of distance on one full charge for the big electric vehicles, right? So, you know, it's like the infrastructure gap has essentially meant that to solve the problem we wanted to solve at any kind of scale, we've had to go back to the drawing table to help build what made sense. So today we have a large assembly plant in one of the Nigerian cities we operate in, where we actually take these vehicles that we import into the country and assemble them and make it worthwhile, and people can actually use them and operate, right? So that's something we've had to do from a place of the infrastructure. So till today, people always ask, oh, why aren't you doing a ton of cars? We're like, yeah, because the infrastructure doesn't actually support the cars yet. But I mean, the great thing that we've also seen happen in parts of Nigeria is that we now have like trains that have come online. The government is investing massively in like bus transportation as well, and that's pretty exciting.
Cool. Thanks, Chinedu. Youngsik, I mean, as a lender, have you seen or been able yourself to deploy capital and support some of these earlier stage ventures to help plug the infrastructure gap as opposed to just investing in their core business? Or do you see it as a blend of the two?
Yeah, so I think the one who suffered the most due to the lack of infrastructure probably be small and medium-sized enterprises, SMEs, and SMEs in Africa represent quite a substantial portion of the total business compared to other regions globally, which means the SMEs is critical. The growth of SMEs is critical in the region. So what we do in Citi, we collaborate together with DFIs in Europe, Japan, and the US. We provided the long-term financing solution to a local banks in each of the countries in Africa, who then able to mobilize those loans to the local SMEs, especially women business, in order for them to grow their business. So this is one of the initiatives that we are doing together with DFIs globally.
Thanks, Youngsik. Okay, let's change tack now to regulations. I mean, you know, one of our best examples, I think, of adapting regulations and unlocking a significant piece of infrastructure is South Africa's Renewable Energy Independent Power Producer Program, where it had its own sort of fits and starts, but essentially that program has mobilized billions of dollars into our utility scale wind and solar and CSP projects. So let me start with Kola. I mean, do you have another example, or how do you work with the regulator to try and encourage change, accelerate change to unlock infrastructure?
Thank you for that question. It's actually quite challenging, the regulatory environment, and I'll give you two examples of things that have worked and one that hasn't worked. The telecommunications sector in Nigeria, you have about 4 major players and a 5th one that is on the brinks. And because of their small number and their very strong voice, they have been able to work effectively with the regulator and, you know, basically garner support to ensure that they have a very well-regulated, well-regimented plan that is executed upon. And so, you know, they work with the regulator. They also inform the regulator when, you know, so basically, if you take, for example, the licenses that were released, so the 4G licenses, the 5G licenses, these guys work with the regulator. They give feedback to the regulator constantly as to the issues they had in 3G licenses and how that should be resolved going to the 4G licenses bid, and so on and so forth. And that has worked very well. And given how large a component of the GDP telecoms is, you would expect that, you know, you see something similar in the electricity subsector. Unfortunately, the electricity subsector has only just been better regulated, I would say, in Nigeria, for example. And that issue was partly to do with the nature of the different companies in the sector. They didn't have such a strong voice and united voice, and they were not able to put through their own a regulatory framework that actually allowed them to grow. That tariff increase you mentioned in South Africa wasn't accessible for the market for a very long time, and that actually delayed the improvements that a lot of people had expected to see over the past 10 years in the electricity sector in Nigeria. Now, that has improved recently, but it's taken a long, long time to actually get there. And with poor regulation, you end up losing a lot of time, a lot of time where infrastructure could have been developed at a much faster level.
Rachel, I think you had another very interesting example of, you know, regulatory change really damaging a sector. Maybe over to you to expand on that.
Yeah. On the opposite side, there was the example of the 2008 bill in Uganda, where a regulation applied to the telecoms actually really hurt the tech ecosystem. So it was a social media tax overnight, where users had to pay 200 shillings a day to access social media. And at the time, the tech ecosystem was just growing and really getting on its feet. And I think they lost 15% of total subscribers in 3 months. And over the course of the first year, it was I've got the actual number here, so I don't say it incorrectly. 15% of users in the first year. So they lost 5 million internet subscribers in 1 year because of this additional tax on social media. And hundreds of startups that had initially built this into their business models failed over the course of that year because the affordability was became a problem for users. So this regulation deeply hurt the tech ecosystem. And many of these solutions were fintech solutions for small businesses, access to education solutions for people in remote areas, you know. It was the fundamental things that were really making a difference, and that one regulation just really hit the ecosystem hard. One thing I will say is that we do see some growing movement around participatory regulation, where the public sector is engaging the private sector at different stages to kind of co-design policies, co-design regulation. You have a couple of examples like the Startup Act in Tunisia, the Startup Act in Senegal, where they brought together ecosystem actors in hackathons and really kind of thought together collectively about what is the right regulation and policies to facilitate tech and startup innovation. So that's great to see how that can influence digital infrastructure.
Okay, thanks, Rachel. Martin, I think you've got something a bit more positive where I think better or more certainty supported the growth of the sector. Martin, was that the Triple P? Yeah.
So in terms of regulation, what we have seen, I think, you know, I started this job in 2005, and if you look at our book, it's largely financing of PPPs and IPPs. And back in 2005, there were, at a conference like this, there were a handful of developers out there, and only 1, maybe 2 IPPs were closed on the African continent today. I think this model has rolled out throughout the continent and is something that works. And it has, I think, delivered in many cases that, you know, power rationing or load shedding has reduced in a lot of countries. So you can bring in the private sector and you know, get it externally financed and you know, deliver an affordable service for the citizens of that country. But I think a lot more can be done. The standardization of PPAs or offtake agreements or concession agreements, the licensing agreements, I think in many countries, you know, can be improved to make it easier for private sector investors to come in. You know, there's examples in South Africa that were quite successful. The RE program for solar, for renewable energy. I always refer to the Get Fit program in Uganda, which was sponsored by the government of Uganda and KfW. Something that really worked. Standardized offtake contracts, concession agreements, direct agreements, a whole package, well defined with the input of the private sector in there. And then it was launched, and for instance, we still have 10 small renewable energy assets in our portfolio in Uganda to date. IFC did something similar with scaling solar. I think these programs we need to see more and more. Especially they happen in the power sector, but we did a water PPP in Kigali, Rwanda, a couple of years ago. The Kigali Bulk Water Project is up and running right now and has you know, reduced water rationing in Kigali significantly. And we hope that that model can be replicated in the water sector, because you can achieve the same thing as you did in renewable energy or other power projects. You can do the same in affordable housing. You can do the same in transport. And if you bring in the private sector, you know, there's a cost to it, but long term, you know, you will benefit from it. And especially when governments are constrained, you know, I think there can be an acceleration to close the infrastructure financing gap and the infrastructure deficit on the continent, but then you need to invest more in upstream support and developing these kind of projects. And secondly, I think developing these projects also on the end user tariff and the tariff of these offtake agreements. I think there needs to be more transparency in that and clear mechanisms how tariffs are being adjusted. Some countries do that very well. You know, they have adjustment mechanisms for inflation, forex, and other metrics, and it's a very transparent, and as long as you implement that, you have a stable system and a reliable system, and that attracts investors. And the third item that I think needs to happen, still a lot of these PPPs are financed in dollars or euros, and that creates a mismatch for these governments who take ultimately on that risk. And there are pools of pension fund capital that is currently not investing enough in these asset classes. And there are loads of initiatives trying to do that. So again, in the design of these programs, think of your local pension pool. And, you know, although you're not able to switch completely from hard currency to local currency, create structures where it's a hybrid. You know, create shorter dated tranches for local banks, or do mini-perm structures. So there's lots of ways to attract local capital. It might not always be cheaper because local interest rates are occasionally higher, but it reduces the risk, that balance sheet risk of the sovereign on these projects.
Thanks, Martijn. I think if I had to pull the regulatory discussion together, the biggest thing that, including ourselves as asset managers, the private sector is looking for is certainty. As we've seen in South Africa, the two examples you've given now, Martijn, Namibia has also had a very successful 5 megawatts refit program, you know, where 14 projects were connected to the grid very, very quickly after the program was launched. There's still a few sort of sitting in limbo. But the developers, funders, operators were all willing to participate in the market because there was enough regulatory certainty, whether that extended to the PPA, obtaining environmental authorization, grid access. There was enough certainty for everyone to understand what the rules are and how to go about achieving success. So for me, that was the biggest sort of driver of private market participation, is that certainty around what the regulatory framework entails. Okay, so as we've seen, when we spoke about inflation and other pressures. It's very much a case of there's a lot of pressure on fiscuses across the continent. Governments are all falling short, in terms of collections. Inflation rates are pressing or squeezing upwards. Interest rates are rising in response to that. And yet we need to deploy all of this, billions of dollars to try and develop infrastructure. So let me start with Youngsik. How do you, particularly with export credit and working with DFIs, how are you able to mobilize capital and sort of reduce or keep the cost of funding reasonable rather in some of the projects you've worked on?
Yeah, sure. So for large scale of infrastructure project, especially in Africa, a support of export agencies or multilateral agencies is quite critical, providing a very long-term financing for the borrowers. In July this year, there has been a new OECD arrangement under which now ECA will be able to provide a support of over 20-year repayment period of support for infrastructure project, depending on each of the different sectors. So now the ECA support is becoming more important than ever for those infrastructure projects in Africa. So ECAs, they provided support across most of the sectors, including hospitals, road, port, airport, railway, all those transportation and renewables and water projects. We have worked with different ECAs and multilateral agencies across Africa for those infrastructure projects. And early this year, we have arranged a financing for the expansion and upgrade of the airport in Zanzibar, Tanzania, with the support of UK Export Finance. And this is financing that we have concluded within less than a year, providing a critical support for the island in the countries. And the successful financing is expected to not only contribute to economic growth in the island, including the direct foreign investment and attracting more tourism, but also to contribute to create more employment in the island. So and many of the ECA, they are there to promote the export of their own countries, and we see ECAs are becoming much more active than ever across the globe, but in particular in Africa. So I believe the support from ECA will continue in the region.
Thanks. Before I hand over to Martijn quickly, I mean, I remember that project, so that pre-COVID already, so this was probably 2018, 2019, that new terminal building was probably about 2/3 complete, and it's now finally attracted funding. So that's project has been there sitting waiting for the right funding mechanisms to bring it to fruition. So I'm glad that you were able to mobilize capital and get that one over the line. Martijn, do you want to add on another?
Yeah, indeed, interest rates higher, inflation, supply chain issues. We have definitely seen a slowdown, especially in very large project finance projects. Obviously, because a lot of these projects, 2 years ago when you started to think about these projects, if you would do it today, you completely need to go back to the drawing board in terms of economics and cost. But then I also say, this is not unique, right? Inflation happens. We're quite at a spike. Interest rates are higher, but we have been here before as well. And actually, I looked a little bit back over my whole career over the last 20 years, and these interest rates we have seen before, and also then we finance infrastructure projects. So inflation is painful, costs are going up, but these need to go through economies, and they will settle at some point. But I think there are a couple ways that we can soften the pain somewhat at this point, and a couple ideas that we always have. Indeed, multilateral support in terms of PRI, political risk insurance, ECA cover on certain tranches, helps to bring the cost somewhat down. You have a number of funds that can provide credit guarantees on these. Obviously, those premiums are also somewhat higher at the moment, but again, they will help to get people over the line to continue to invest. So other pools of capital that you have is kind of concessional capital. There's clearly a need for that, especially if you want to finance the transition. We use that occasionally, for instance, in solar PV projects plus battery, right? In solar PV, it's quite economical, low cost. You can finance that without any subsidies in most instances. But if you add a battery, which is badly needed and needs to be accelerated, we use some concessional funding to bring the cost down and to get an affordable tariff. And hopefully we'll see the same trends in battery prices that we have seen in solar PV, and then they can be rolled out in more scale. Another thing is I think we need to be creative. Governments need to be creative, utilities need to be creative. If you agree on a debt financing right now, 75 to 80% or 70% of the total project cost at a base rate, let's say between 4 or 5%, depending on how you look at the swap curve. You know, in a couple of years' time, that might not be the same rate anymore. So build into your concession agreement refinancing options. And you see those occasionally where some of the benefits of a refinancing, if it leads to a lower cost, are shared between the equity developer and the off-taker, right? So there's a way to think, okay, you know, I take some pain right now, the costs are higher, but if the prices come down, I will see the benefits of it.
Do you want to add to that?
I mean, I think you've touched on two very, very important topics. One is the blend of local currency financing and hard currency financing. It's very important that that blend is optimized because then that really reduces the burden of trying to repay back the hard currency loans, especially in situations where you have significant devaluations over the lifetime of the infrastructure asset. Also, the other thing to work on, I think, is I think we do not focus sometimes enough on the optimal infrastructure asset to deploy capital to. So, you know, in some cases it's the port. It could just be a simple case of I need to improve my export proceeds from this country, and so I need to improve everything around the port asset itself, the roads and rail links to the port, the power for all those companies that work around that area. First, as the first step, before you now work at developing the rest of the country. But there are opportunities to cherry pick good infrastructure assets that can repay over the long term, and blend this with you know, local currency financing to actually optimize the assets. So that's it.
And then just before we move on to the next topic, so again, a good example in South Africa and Namibia is both the energy PPAs provide for benefit sharing on refinancing. And we've seen, you know, a good 30–40% of projects have now hit that refinance milestone. You know, the developers obviously benefit, or the owners benefit from a liquidity event on the refi, lower interest rate going forward, and that's also shared with government in a tariff adjustment. So tariffs is rebased, and then escalation starts again. And similarly, Namibia makes provision for that refi benefit to be shared with government or with the off-taker when the refi event happens in the solar projects. Let me come back to Chinedu to start. I mean, you started earlier speaking about having to adapt your vehicles to cope with the local road conditions. How, I mean, you know, typically we don't associate you know, large parts of the continent with, you know, charging networks, the ability to recharge vehicles, keep them on the road. How did you address that challenge from an infrastructure, building that infrastructure perspective?
I mean, okay, so in terms of building out the infrastructure for charging networks, a lot of what we've had to do is to build out our partnerships with different organizations to figure out what makes sense in each area, right? We've done a lot of work around data to figure out consumption, planning, optimization, and everything else in between. But you realize, for example, that in parts of Nigeria, we're powered by hydro energy. In other parts, people are using generators. The way you power in Ghana, for example, varies from provider to provider. And the way we power in Cameroon also varies from provider to provider. So what we've had to do from an infrastructure standpoint is to figure out in each particular geography that we're operating in, what makes the most sense from a source of power standpoint, right? And essentially collaborating with the companies that operate in that area, in that space, to work with them to roll out what makes the most sense, right? We've also done partnerships with large-scale petrol distributor companies like downstream oil and gas companies in Nigeria. We've done a partnership with at least one of them, where we're able to now leverage their infrastructure to build and roll out charging stations as well, or swap stations as it is, right? I mean, another key thing obviously is you look at the availability of power and how that works, and you realize that different people run different kinds of things. So we had to adapt a model that didn't depend on the US model, which is to charge everything, where you have a bunch of charging stations in place. Instead, we went to the model that was built for what we do in Africa, which essentially swaps, right? So rather than going out and charging your batteries, you're just going to go off and drop off one battery and pick up the battery. Another thing we also optimize for is if you take into account the cost of a two-wheeler plus the battery. A battery alone is about $1,000 on the motorcycle. The drivers are not going to pay for that, right? Good luck, we can pay for it. So what we essentially have done as well is to build out a business model that supports that, where for the drivers on the electric side, for example, they're able to do a lease to own for the chassis of the vehicle, but the batteries remain owned by our network. And essentially we swap batteries for them and rent batteries to them, so they're able to operate and work, but they never have to actually take over the cost of the battery. So what that does is that for the drivers, the cost of the chassis on the EV is comparable to the cost of the gas engine vehicle. So it's not a big jump for them to make, right? However, where the real value then becomes for the drivers is they're able to save 70% on their OPEX by switching from gas to electric. So we've had to essentially play around with the business model, the infrastructure availability and everything else in there to make this a much better product for the drivers, to be able to deliver to them at the last mile. So that's what we had to do.
I think, just on that theme, one thing that worries me is there is an opportunity as we move into new infrastructure, whether that be electricity generation infrastructure, EV charging networks. My fear is that we're not really using the opportunity to focus on just transition and ensure. If I look at the South African example, where our filling stations are still manned. So you have people, South Africa, Namibia, and Lesotho, that will come to your vehicle and fill up your vehicle, fill up the car for you, and then take payment. It's not the self-service model that a lot of Europe sees. And my worry is that without bringing those, and that's a real opportunity to bring those employees and look at ownership models where they can start being part owners of the new generation of fleets and charging networks, as opposed to being, while a very dignified role, and it's not a route to wealth creation. It's really a job, it's a very dignified job, but we're missing out on the opportunity to really accelerate just transition if we do not bring local, that's our 5-minute bell, I think, local partners along with us. Any thoughts, any sort of places where you've seen that work, where it's actually part and embedded in the rollout of that infrastructure is a focus on just transition? Or is that something we need to get back to our host countries, to our regulators, to say, guys, we're really missing an opportunity here?
I mean, from our point of view, what we've done in some cases is PPPs, where it's a build, operate, and transfer. And so we have a hurdle rate, which is pretty conservative for an aggressive investor. But, we, especially in healthcare, what we have done for our healthcare assets is, sign a BOT kind of structure, where we actually build it, we operate it for a few years, make our hurdle rate, and then we give back to the government. So that has worked in some of the investments we've made, but I'd like to learn what my other colleagues are doing.
So something we've done around this, in rolling out the EVs in Pacific communities, what we've done is to actually seek out where they have mini grids. Right? So they have mini grids built with solar or whatever other kind of source of energy. Whereas what we've seen, especially in Nigeria, is a lot of the companies that have mini grids struggle for demand. Right? And so we rolled out, so we did a project in one of the communities in Ogun State called Kolawole, where we rolled out 20, just as a pilot and test, 20 electric vehicles to see what the community would use them for. What we found was a bunch of people were using them for passenger transportation, right? Actually renting the vehicles and using it to carry passengers all day. We also found that there were a lot of farmers who would use the vehicles as well, and would actually use them to go pick up load at the farms and take them to the farm gates, right? And so but in those particular communities, we essentially built an ecosystem where you had the mini grid provider on one side producing power, you had us providing the consumption, and then you had the community essentially using the two of them combined to deliver a bunch of other stuff. So I think that's what we've done, and we've seen that actually worked as well for like targeting specific projects like this.
It's awesome to see that sort of extended value chain and not just focusing on one aspect. Okay, we've got time for one or two questions or comments from the audience. While people are thinking about it, I'm going to pose a challenge to the panel, and this one, none of them know this is coming, so let's see. So, $100 million allocation, you can invest in infrastructure on the continent. Where would you invest it? What specific type of infra would you invest it, and why? 30-second elevator pitch. If I like your answer, I'm writing the check at the end of the session. Who's going to go first?
Okay.
Go first.
So, a bit of a backdrop to that is, if you look at agro-produce, African food producers in West Africa, especially Nigeria, lose as much as 30-40% of what they produce to transport costs, right? And the biggest delay of the causes that delay is the way the produce is shipped, the amount of waiting they have to do. We talk about farm gates and everything else in between. And what we've seen is, for a lot of the farmers, they don't actually have a way of like moving things around. And so a lot of that loss happens at the farm before they get to the farm gates. $100 million would be to electrify invest essentially in swapping stations and building out like good roads to help provide a route to market for folks who own farms across the continent. If you look at Nigeria, look at Ghana, look at a bunch of other places, because in doing that, you essentially double the path, so like potentially double revenue for them, right? Which effectively means that with the same amount of cost that they were dealing with initially, their outcome is a lot different, right? Better profitability for them. Better profitability for them means higher productivity. Higher productivity means potential for export. Potential for export means you essentially can drive down the cost of quality of life and a bunch of other things and actually see better inflation. I'm
going to stop you. That was 90 seconds, so you're not getting the check today. Who wants to go next?
So I'll say flare reduction on oil and gas sites. It's terrible that you have energy deficiency across the continent, and you have a lot of flare going on. The same energy is just being burned and not being utilized. And basically, $100 million will go towards projects that capture that gas and utilize it either for cooking or for electricity or whatever it is.
Thanks, Kola.
You go.
Saved by the Bell, I put it in the cold chain, just 40% wastage at the moment. It's a lot.
I would say renewable energy, because it makes, in most cases, a lot of economic sense, especially in C&I, telecoms, fiber, data centers, and then logistics, warehousing, cold storage as well.
Yeah, I'll say the agricultural value chain and the products. Africa has a huge potential for the export of the agricultural product. I think one of the issues is the warehousing and transport of those products being produced. So especially under the current food security environment, I believe it is an area that has a huge potential for the investment.
Thanks. I'll take 10 seconds. I'll just say water to me is one of those critical parts of infrastructure that's significantly underinvested. But it is heavily dependent on the regulatory chains. On that note, let me hand you back to our chair. Thank you. Thanks, Thank you.